Hello, everybody. Good morning. We've just signed in a little bit early. I see there's a few who've already signed in, so bear with us. We will be starting very soon. Thank you. Hello, everybody. A very good morning to you. Um, we have quite a few people signed up today, so we'll wait another minute or so just for any latecomers who managed to sign in. So hello and a very good morning to you. Thank you very much for joining us today. We've had a really positive response to this webinar. It's exceeded any expectations as far as attendees that we were expecting. Um, the reason we're holding it is because in recent months, and most certainly in the last couple of weeks, we've had a multitude of different companies reach out to us from small local companies to large pharma companies, and especially their staff when it came to discussing their redundancy options. So the reason we hosted it was because there were so many of inquiries on redundancy packages being offered and lack of understanding of what's being put on the table. So people have so many challenges due to either poor communications or lack of information being provided to each and every one of you in regards to the redundancy options, and that makes it really very difficult to make any informed decisions. So hopefully today this is an area that we will be able to address for most of you. Some companies are very, very helpful and they do provide details, but because it's so generic, it just proves very difficult for the average individual to understand how the decisions that they make will impact them personally for now and for the future. So hopefully at the end of this webinar, you'll have a much better understanding of the complexities of these redundancy or severance packages that you're being offered. So Adrian, who you'll meet very shortly, he's going to present the presentation. Oh, there's Adrian on the screen there. Hello, Adrian. Um, it is quite a complex topic. So if you do need to ask any questions, any specific questions that are related to you personally, please do so via the chat box. For those of you who aren't familiar with this forum, there, I know on my screen, my format might be different to yours, but in general, it's over on the left-hand side, or sorry, the right-hand side, and there's a small little question box. So that'll give you the opportunity to flag up any questions that you have. We'll answer the questions at the end of the webinar. We do have a lot of attendees, so we may not get the opportunity to answer every single one, but we'll answer as many as we can within the time frame. We will put up email addresses at the end of the presentation, so please make a note of them and do email us any questions or any details that you'd like to know, and we will happily revert back to you as soon as we can. So what we'll do is, for those of you, I've had the pleasure to meet with a few of the attendees in person. So for those of us that, sorry, I'm having technical problems here. For those of us who, or those of you who haven't had the pleasure to meet any of us, or we've had the pleasure to deal with in the past, this is really who we are. So Oaktree is a family-run business. We're over 10 years in existence. We actually celebrated our 10-year anniversary last year during our COVID lockdown. Hopefully we can remedy that with a proper celebration sometime this year. We have over 1,500 clients, and we do manage over 2 million in assets. We are a very efficient small team of seven staff members. We're not a tied agent, so we don't deal with any one specific company. We deal with all the leading life companies out there and the alternative investment managers. And that just allows us to ensure that we can offer the best solutions to our clients. So with that said, I'm going to hand you over to Adrian, who's going to take you through the presentation. Now, what we're going to be covering today is going to be the statutory redundancy, ex gratia payments, basic and increased exemptions, standard capital superannuation benefits. That's quite detailed, so you'll need your thinking cap on for that one. Waiving the sum from an occupational pension, and last but not least, any other relevant facts that will have an impact on you. So there you go, Adrian, over to you.
Thanks, Tracy. Good morning, everyone. I suppose what I want to try and just cover off, as Tracy said, is some of the things in relation to redundancies. I suppose quite simply, what we're looking at is what is the redundancy made up of. So there's normally this statutory payment, so a minimum of 2 weeks for each year of service plus 1 week. Then you also would have, or may have, a payment in lieu of notice. So if you decide that you're not actually going to work your notice, they may pay you for that period of time as well. And then on top of that, in most companies, you would have an ex gratia payment where it's going to be X weeks per year of service. So that could be 2, 4, 6. In some cases, we would have even seen 8 in the good old days. There's also then where there would be health insurance contributions post leaving, or a death in service continuation. That's something that I suppose in the last number of years has become more prevalent, where we're seeing this health insurance contribution, so a continuation of your VHI and of the death in service after you've left. What redundancy payments are typically made up of is 3 parts: a tax-free element, a tax-exempt element, and a taxable element. So the tax-free element is going to be your statutory, so that 2 weeks for each year of service plus 1 week is totally tax-free. The tax-exempt piece is the piece that we all have to make sure that we're getting right. So whether that's through the basic exemption, the increased exemption, or the SCSB, we need to make sure that we're getting that right for our clients and working that out properly. And obviously all of that then leads to the remaining piece, which is the taxable piece. I will say this presentation it's a little bit like Who Wants to Be a Millionaire. The very first couple of slides are very easy, very simple, and after that the questions start getting a little bit more difficult. So bear with us. As Tracy said, do pose questions, do ask us questions. We'll try and get to them as we're going through the event. We'll try and answer those afterwards. So if we look first at statutory redundancies, so quite simply, you must be over 16, you must have had 2 years of continuous employment with the company, and then all statutory payments, as I said, are tax-free. So what it looks at is your 2 weeks of gross pay for each year of reckonable service. plus 1 week's gross pay. So it's classed as a bonus week. So very simply, it's 2 weeks for each year of service plus 1 week. So what is gross pay? So gross pay is your normal weekly wage plus any regular benefit in kind and overtime. So it's not going to include bonuses or things like that. And one thing to remember is it is capped at 600 per week. So if you're earning 1,000 a week, well, it's only the first 600 of that is taken into account for your statutory redundancy figures. The reckonable service, now this is something that does cause a little bit of an issue for some people. So what is reckonable service? For most, it's very simple. It's the number of years you've actually been there. But it does take your period of employment less non-reckonable absences. So just to give you a kind of a quick idea of what those are. So non-reckonable absences are classed as any period over 52 weeks where you are off work due to an injury at work, any period over 26 weeks where you're off due to an illness, any period on strike, or any period of layoff from work. So essentially, if you've been on strike for 2 months, well, then that is taken off your period of employment. If you've been off work through injury for more than a year, that's taken off the period of employment as well. Partial years are credited for it. And then you also have other absences that don't impact on reckonable service. And quite simply, those are holiday leave, maternity or paternity or adoptive care leave, or where you've been on a career break. None of those actually count towards or impact on the reckonable service. So just to remember that as well for people. So we're going to look at a quick example here. So you may recognize John. John has been made redundant. He started work in March 2001 and his expected exit date is 1st of April 2021. So in total, he has worked for 19.27 years. Now, the reason we have it worked as 0.27 is to kind of show you the effect in each of the situations. So his gross weekly pay is 1,682. But again, as we mentioned, it is capped at 600 in order to calculate his redundancy entitlement. Now we're going to use John throughout the whole of this presentation. So each time you'll kind of see these figures being repeated throughout the exercise. So we take our 600 euros per week, multiplied by 2, by 19.27, because obviously he's worked for the 19.27 years, plus that bonus week of 600. So he's now entitled to a statutory redundancy of 23,724. And again, that element is tax-free. You do have situations where a company may be unable or unwilling to pay. So obviously, very simply, what normally happens is the employer passes the money on to the employee in a situation where they're able and willing to pay that statutory redundancy. In a situation where they're unwilling or unable to pay, the employee does have the option or the option to approach the social insurance fund. And while it's rare, it would have been something that would have been seen over the years in around 2008, 2009, 2010. You know, there would have been quite a lot of media coverage of companies where employees were having to go to what was then the Employment Appeals Tribunal, which is now the Workplace Relations Commission, to actually get the money from the employer through this social insurance fund. So in most cases at the moment, what we're seeing is that the employer is in a situation where they're willing and able to pay. But just for those employees who might be fearful in relation to their statutory redundancy, there is that option of the social insurance fund as well. So if we move on then, if we're looking now at ex gratia payments, so these are voluntary payments made by the employer over and above the statutory redundancy. In most cases, it's going to be cash. It's rare that you would see something else, but there can be non-cash benefits provided to the employee as well. And that can be a car, it can be stock within the company, as in physical stock, not stock or shares, and our computer equipment. Again, in most companies, what you'll see is it's actually going to be a cash payment over and above the statutory redundancy. So with the ex gratia payments then, as I mentioned to you, there are 3 areas we need to consider when calculating that tax due. So this is now in our tax exempt piece. So we're going to look at the basic exemption, the increased exemption. Remember, with this, it does need prior revenue approval, and the one that nobody can ever remember what it actually stands for, which is SCSB, Standard Capital Superannuation Benefit. I'm not going to repeat it again. It's SCSB. It makes it an awful lot simpler for the rest of us to try and figure out what it is. And with these 3 exemptions, it's going to be the higher of the 3 that will be exempt from tax. So this forms our big piece of exemptions from tax. So just moving quickly through to the basic exemption, quite simply, it's 10,160 plus 765 for each full year of service. So under the statutory calculation, we were able to use that 0.27 of a year. In this, we won't be able to actually do that. So look at John again. So John has now received a termination payment of 200,000. Again, he has worked for 19.27 years. As calculated, the 23,724 is our statutory redundancy and is tax-free. And so his basic exemption is calculated as 10,160 plus 765 multiplied by the 19 full years that he has actually worked. So on top of his 23,000, he now has another 24,000 that is going to be tax-free. So just running a quick calculation on the tax liability then. So his overall payment is 200,000 less the statutory, less the basic exemption, gives him 151,000 taxable. And that is taxed then at the marginal rate plus USC. There is no PRSI included on it. So marginal rate is 40% income tax and 8% typically on the universal social charge. So his total liability there is about 72,000 on his 200,000 lump sum that he's receiving. And that's using the basic exemption. So if we move on then to the increased exemption, so this is where it starts to get a little bit complicated. So the basic exemption can be increased by 10,000 where you have not claimed a termination payment in the last 10 years. So if you've been made redundant in the last 10 years and used the exemptions previously, you can't now use this. You also must look at a situation if the individual is not a member of an occupational pension scheme or they irrevocably waive the right to receive a tax-free lump sum from the occupational pension scheme. So most of you that have received paperwork in relation to redundancies at this stage will have been given what's known as a net present value of a future tax-free lump sum. It's complicated as to how they even come up with that, and we talk about that a little bit in the future. But if you're in an occupational pension scheme, an employer-led scheme, you are entitled to a tax-free lump sum on retirement. If you decide to waive that right to a tax-free lump sum now, so you won't receive it in the future, then you can use this exemption. So I'm going to run through 2 examples here and kind of give you an idea of it. So if the tax-free lump sum exceeds 10,000, well, then there's no increased exemption because obviously 10,000, if it's over 10,000, you won't be able to avail of it unless you waive your right to that future tax-free lump sum. Okay, so I'm going to move on just to have a quick look at the exemption. So again, in this situation, we're back with John again. He has 176,276 is his ex gratia portion here. He's no previous tax-free termination payment, so that means he hasn't received one in the last 10 years or never had one. So he qualifies for this. He is a member of an occupational pension scheme, and his current net present value of that future lump sum is 9,000. So what that means is we can actually look at using this increased exemption. So again, that's the statutory piece, that's our basic piece. So now we look at the increased exemption. So he signs the waiver on the lump sum. it means that he, at retirement, will not be entitled to any tax-free lump sum from his pension. His increased exemption now becomes the basic plus 10,000, giving him an exemption of 34,000 in this situation. If he decides, that leaves us with 142,000 then, which is taxable. But if he decides that he does not want to waive his right to that future lump sum from the pension, then what happens is it's 10,000 minus that net present value piece. In our example, we were saying that that net present value was 9,000. So there's a difference of 1,000, and that gets added on to his basic exemption. This is quite complicated, I accept, but in the next example, when we're looking at SCSB, I think it becomes a little more clear as to how it all fits together. There is another piece to this though as well, because in most situations, if you've worked for 19 years, that tax-free lump sum in the future is going to be worth an awful lot more. So if we now look at an example where that net present value of the lump sum is 41,000, well, then that completely changes everything. So again, we have our statutory, we have our basic. Again, if he waives the right to receiving that lump sum in the future, he gets his 10,000 increased exemption right now. If he does not sign that waiver, then the 10,000 just becomes zero, because it's 10,000 minus 41,000, which is obviously zero in terms of the calculations. So where he does not sign the waiver on the lump sum and the net present value is greater than 10,000, then there's no increased exemption. It just becomes the same figure as the basic exemption. Okay. Now we're on to the fun one, the SCSB side of things. So typically this does give a higher exemption figure than the increased exemption or the basic exemption, where an employee has long service or has high salary. So the standard formula for this, again, quite complicated, but as we work through the example, hopefully should become a little bit clearer. So it's A times B over 15 less C. So A is our average remuneration over the last 3 years prior to the date of redundancy. B is our number of complete years of service, and C is our net present value of any tax-free lump sum under the employer's occupational pension scheme. Where the lump sum is waived, as we spoke about, so it basically means that we've decided not to take a tax-free lump sum in the future, C becomes zero. So what's included within the SCSB? So under remuneration, which is A, our total income liable to tax under Schedule E forms part of our remuneration. There's no cap, no 600 per week statutory cap included. It includes all bonuses, all overtime. I suppose the way we would have always calculated this was it was the figure on the P60. So that's how it was typically done. Obviously the P's are gone now, but it is still that figure that is reported to revenue. Service, again, full years of service only, partial years are ignored, and career breaks are not included for service in this calculation. So if we just look at this side of it, so the net present value, I want to talk a little bit just on this. So that net present value on the lump sum in the future does depend on a number of things. It depends on whether you're under or over the age of 50 and whether or not you're actually going to take those benefits now or defer. So if I'm 50 years of age or over, am I going to retire now? I'm taking my redundancy, do I retire now? Or am I going to wait another 10 years until it's closer to what would have been known as the normal retirement age, maybe 60 or 65? So it does depend a little bit on what you're actually thinking of doing as to how these calculations are come about. If you're retiring now, so I'm 50 years of age, the net present value of my lump sum as calculated is actually the figure that is available right now because I'm looking to retire. If I'm not going to do that, if I'm going to defer it, if I'm going to wait until I'm 65, then it's actually a figure that needs to be calculated by the provider. As I said to you, it's what it's actually known as is the future value, or sorry, the net present value of the future tax-free lump sum. So there are a number of calculations that need to be done to get to that. Assumptions vary differently, and there's no explicit revenue guidance as to how to calculate this figure. So, you know, in a situation like this, it is up to each and every provider. So the company that's actually looking after your occupational pension scheme will be the one that will actually tell you what that figure is for your redundancy situation. Okay, and it is capped at 200,000. Obviously, any tax-free lump sum from a pension is capped at 200,000. So it's just to bear that in mind as well. So again, we look at John. We go back through his situation. So the net present value of the future of the lump sum at the moment is 41,000. So his average earnings in the past 36 months have been 105,000. And how that's calculated, it's literally his salary over the last 3 years. So if we assume we're on the 1st of January, just to make it simple, we would look at his salary in 18 of 101,000, 19 of 105,000, and 20 of 109,000, and divide that by 3. Again, his basic exemption is 24,000. If he signs the waiver on the increased exemption, he gets that additional 10. But we can use this SCSB figure if it is higher. How we calculate it? We take the average earnings, that 105,000, multiplied by 19 years over 15. And the reason we have 0 there is because we're saying that he has waived his right to that tax-free lump sum in the future. So the higher of the 3 figures here is obviously 133,000. So that means that portion is exempt. So we then take our overall benefit, which was the 200,000, minus our statutory, minus our SCSB figure, and we now end up at a figure of 43,000 taxable. So if you remember earlier on, we were at a much higher figure in terms of the taxable element. I think the tax calculated earlier was about 72,000. The tax payable in this situation is 20,000. So there is actually a huge difference when you use the SCSB. But what if he decides that he wants to retain his right to that tax-free lump sum in the future? So again, he wants to wait until he's in a situation at 65 or whatever age, and he wants to take a lump sum from his pension as well. If he does that, so we're now in a situation where the basic exemption and the increased exemption are the same amount, and we then have to recalculate our SCSB, taking into account that net present value of the future lump sum, which is 41,000. So his exemption now drops from 133,000 down to 91,000. So the tax on that means he is going to pay more tax. So the tax payable now is 40,000. Yes, there's an additional 19,000 in tax right now, but he now retains that option to receive a tax-free lump sum of 41,623 at a later stage. Now I have an asterisk there on the 41,000, and I'll tell you why. And the reason for that is because if this guy is 50 now or in his 40s, he potentially has another 20 years where that pension fund has an opportunity to grow. So while the net present value today is 41,000, that figure may actually be higher in the future. So just to go through some issues then in terms of waiving that tax-free lump sum from the occupational pension scheme. If you do decide to waive it, you are waiving all lump sums from all approved occupational pension schemes relating to the employer paying the termination payment. So Company A has a defined benefit scheme, a defined contribution scheme, and an AVC scheme. So what you're doing is you're waiving the tax-free lump sum from all 3 schemes if you waive it at all. So just bear that in mind, because sometimes that's not actually explained to members, we find. So it is something just to be aware of. You cannot waive part of the lump sum. you must waive it all. Unfortunately, it's an all or nothing situation on this. You don't actually get away with just waiving a portion to cover the ex gratia payment. It is important to remember that personal pensions and PRSAs are typically outside of an occupational pension scheme and are therefore excluded. So some people may have other pension schemes outside of their occupational scheme. The waiver only applies to the tax-free lump sum. It does not apply to the retirement lump sum above 200,000. Just to give a kind of a quick example on that, if you have a fund of 900,000 in your pension scheme, 25% of the fund works out at 225,000. The first 200,000 of that is tax-free. If you've waived your right to that, then you don't receive that 200,000. But it doesn't stop you receiving the 25,000 portion, so that piece above the 200,000. You can receive that. It won't be tax-free, but it is now taxable at the lower rate of 20% because it's actually a very it's allowed under law at a standard rate of 20%. So it's actually it's something to be aware of for some people where their pension funds are over that figure of 800,000. Okay, so what you're looking at here is that waiving that tax-free lump sum can be a huge decision for employees. Yes, there's a higher termination lump sum now because you're obviously paying lower tax, you have a higher exemption figure. But remember, you now have no tax-free lump sum in the future. If you do it the other way around and where you pay the tax now, then you do retain that right to the tax-free lump sum at retirement. As we mentioned earlier, yes, you could be paying 20,000 now in terms of additional tax, but in the future you do have the right to get that 40,000 tax-free lump sum at retirement. It will depend on whether you have an immediate need for cash. Do you need it right now? If you don't, then you can avoid, you can retain that right to the tax-free lump sum. For a lot of people, what we try and kind of explain to them is that you don't know what your future is going to look like. If you don't need that cash right now, look at holding it and getting that tax-free lump sum at your normal retirement age, which, as I said, could be between 60 and 65, depending on the scheme rules. But what it does is it makes sure that you're protecting something for the future for yourself. It also, what we see with a lot of people is that they do focus on that lower net present value. So again, that 41,000 that we had in our example, you need to remember, as I said, how far out from retirement are you? Will that figure grow? Is it going to grow significantly? Is it going to grow at all? That will depend. So if you're 60 and you're looking at taking it in 2 or 3 years time, the growth factor mightn't be there. But if you're in your 40s and not looking to take that pension until your 60s, then obviously it will grow. So again, you just need to be looking at that. Age will be a huge factor, as I said. So again, it depends on whether you're in your 40s or your 60s when you're actually looking at that. One thing that also needs to be considered here is the defined benefit versus the defined contribution side of things here in terms of calculating that tax-free lump sum and how that can impact the actual benefits that you can receive, especially under a DB scheme. And they're known as commutation factors. So we just need to look at that as well for people. I'm not going to go into DB schemes or DB versus DC in this event, because I think there's actually so much out there in relation to it, and it's such a complicated issue in its own right that I think you're better off just actually dealing with it separately. So if there is anyone on that has a DB scheme that does want us to look at it for them or talk them through it, then absolutely we can do that. So when you're looking at the pension figures at retirement, it's important to remember that the figure in your redundancy pack, again, as I mentioned, is this net present value. So it's not actually a correct figure. So if you're in your 40s, you're getting a net present value of 41,000. Remember, that's the net present value of a future tax-free lump sum. So where you have a client who's 47, he has 20 years effectively to retirement, projecting that figure of 41,000 forward, the figure could actually be over 70,000. So now the question is, well, is it worth paying 20,000 now to receive a potential 70,000 in the future? And again, that will depend on your own personal circumstances. Do I need the 20,000 now, or am I okay to hold and retain that right for 70,000 in the future? Excuse me. Okay, so just looking at some other relevant facts. Sorry, now just move on. Okay, so in terms of limits, there is a maximum lifetime exemption limit of 200,000 from all redundancies. So you just need to remember that if you have been made redundant in the past. If you're taking a second redundancy, the previous amounts are taken into account. So you may have been made redundant, let's say 8, 9, 10 years ago and received 100,000 back then, and you could be receiving 200,000 now. So obviously the additional amount over that limit will be taxable. It will come into play. You still have the right to retain that 200,000 tax-free lump sum. So your redundancy doesn't count towards that. It doesn't impact that figure. What impacts that is only if you've taken that waiver. And all ex gratia payments in excess of 200,000 are going to be fully taxable. So again, that's because of the limits that apply. Where you've been or where you're taking a subsequent redundancy, so let's say you're being made now, or sorry, made redundant now, and in 5 or 6 years' time, you're made redundant again. You do have the option for this increased exemption only where your second claim is not in the last 10 years. So in that situation, if you've been made redundant again in 5 years, the increased exemption won't apply. The basic exemption and the SCSB are generally available against any subsequent lump sum unless it's from the same employer. So you're employed by company A, you're made redundant, in 12 months time, you get another job back with them again, and you go and 5 or 6 years time after that, you're made redundant from the same employer as the first time, or an associated employer, then that basic exemption and SCSB will not apply. So you can't effectively be made redundant and claim the exemption twice from the same employer. Lifetime limits again apply in both cases, that 200,000 figure. Some things we do see a lot of is actually pension contributions before being made redundant, before actually the final button is pulled on the redundancy. So where you have an employee or an AVC or an AVC PRSA, they can be made, but they must be paid before the employment is terminated. So if I'm being made redundant today, then I need to make those payments before today. I can make them today as well, before my employment is actually terminated. So these can work really well where the current fund value is less than the revenue maximum lump sum at normal retirement age. So again, if you have a situation where you have scope within your pension fund to invest additional contributions, then this is the right way to do it. Get it done, get the tax relief on it, and it can be done before you're actually terminated. What you do need to remember with it is that the date the employment is terminated is the date of the notification by your employer to revenue. Again, what it used to be in the past was the date on the P45. Now, because the way it's a live notification to revenue, it will be notified immediately to revenue. So it does need to be done before you actually leave. In some cases, you can actually get the tax relief on those payments going in at source, so it can actually be done on the payroll and before the termination date, depending on how the payroll is actually run by your employer. The tax relief on the pension contributions cannot be claimed after the taxable redundancy payment is made. So again, it must be done before you leave. It must be done before the revenue have been notified of your termination date. Okay, so just having a look at a quick example. So Frank is 58, being made redundant. He's 32 years of service at the date of leaving. His normal retirement age is 65. His current salary is 65,000. His current defined contribution fund value is 70,000. So under revenue maximum rules, he's allowed to take out 84,300 in terms of a lump sum, tax-free lump sum in the future. So how that's calculated is he's 32 years of service out of a maximum of 37 years service, multiplied by 1.5 times his salary. So that gives us a figure there of 84,300. Each scheme is going to be slightly different in terms of the values and the number of years service and things like that, but typically this is what you'll see. Assuming he's not waiving the right to a tax-free lump sum in the future, he could pay an additional 14,300 into his pension and get tax relief on it. The maximum tax contribution relief he's allowed to do is 22,000. Again, it's based on his age and his salary, so it's 35% of his salary is 22,000. So he can contribute in that 14,300 straight away before he's made redundant, and he'll be able to get the tax relief on it as well. Okay, so the employer contributions may be made in addition to, but not instead of redundancy payments. I suppose where this is coming from is that it can only be done where it's a shortfall of a promised pension funding. It cannot be instead of, so instead of the employer paying me 100,000, he decides to put it into a pension, it's going to be classed as part of my redundancy payment. It's not going to make any difference to it. It must be made at the same time and before the severance package is agreed. And the employee cannot choose, so this is what I was saying, so the employee cannot choose an employer contribution over a taxable termination payment. It is seen as tax evasion. So what needs to be just looked at there is that if the employer is making contributions to the pension scheme, that they are not being taken out of the taxable termination payment for people. Just looking then at the options in relation to your pension fund. So you're leaving the company, you're been made redundant. What do you do? What happens with my pension? You can leave it where it is. There's a number of things to just remember with that. It is being managed and controlled by your previous employer. So you do need to just be mindful of that they are the ones that are in control of it. It also depends on whether it's a defined benefit scheme. Is that scheme fully funded? And what are the benefits available under that scheme? We have seen situations where what people believe is available under their defined benefit scheme and what's actually available is not the same. You know, where you may have no spouse pensions or things like that. So it is just important to be fully aware of what your scheme can and cannot do. It also depends on the options on retirement as to the tax-free lump sum. So am I restricted in terms of the amount I can take out? If it's a defined benefit scheme, what is the commutation factors? How does that impact what I actually get in terms of my annual payment from my pension? You can transfer to a new employment. So you leave company A, you move to company B. You can move your pension across. There's no problems in doing that. But again, what you need to be conscious of here is looking at the fund selection and the options that are made available to you by that new employer. Are they something that fit with what it is you're actually trying to do in terms of your own retirement? The third option, if I can bring it up, you can transfer it to a bond. So these are just called retirement bonds. It's held in your own personal name. The fund selection is your own choices. You decide what funds it's actually going to go into. Your retirement options, so the retirement options that were available to you within your occupational pension scheme do transfer to the bond as well. But you do also have increased options and other options that are available to other schemes now also become available to you within a bond. So again, it depends on your own personal choice. What we do see is quite a lot of people would move it to a bond because they have much more control of their pension after they've left their occupation or their employment, and as they head into retirement, there's much more options available to them. Okay, what's next? So for anyone on here that is in the situation of being made redundant or having options put to them, do seek professional advice. Like, again, what I would say is over the last probably 20 years, I've dealt with a huge number of companies in relation to pension schemes and redundancies. And what we see is situations where they're not getting the right advice. They're not seeking the right advice because they don't understand what it is they're actually looking for. So we would say to people, just make sure that you're actually getting proper advice in relation to your options, and especially that pension element as you go into the future. So again, from our own point of view, we can do one-to-one meetings with people, and we're available. We're not tied to any one particular company. So if anyone has any questions, I think I've wore myself out from talking.
Well done, Adrian. That was great. Thank you. We've had a couple of questions come in, so let me just go through a few that we've received. One
Okay.
individual has asked, if my employer says it can't afford to pay the redundancy, what should I do?
So if he can't afford to pay it, then there is this option of going down the route of the social insurance fund. So what needs to be looked at there is whether they approach the social insurance fund directly or whether they go through the Workplace Relations Commission. So that will be something that they'll have to kind of make a decision on. What I would suggest is that they contact the Workplace Relations Commission on that one, because it will actually make it easier. The Workplace Relations Commissions will outline what the situation is in that scenario.
Okay, very good, thank you. Another individual has asked, can I be made redundant if I'm on sick leave?
Yeah, so sick leave, there's kind of a few of them that tie in there together. So sick leave and carers leave, the short answer is no. It can be classed as an unfair dismissal in relation to sick leave and carers leave if you're made redundant. Even if there's a genuine redundancy situation arising, you still may be able to bring a claim for unfair dismissal. So that is something to just be aware of. The other one that kind of ties in with that is the maternity leave. So again, you cannot be made redundant while you're on maternity leave, even though it may be a genuine reason. You cannot be made redundant while you're on maternity leave. None of this stops you being made redundant when you return to work, but not while you're on leave.
Just on the same topic, one individual has actually asked, does a career break impact the reckonable service? So if you're...
No, it does for the SCSB calculation, but not for the other calculations, not for the statutory, and it doesn't apply on the basic or increased exemption, but it doesn't apply for the it doesn't impact the statutory redundancy, but it does impact on the SCSB element.
Okay. We've had a few questions here, and I'm conscious of the time, so maybe I'll just go through one or two more. My DB pension scheme has no spousal benefits, but what would happen if I die?
What would happen if you die? It depends on the scheme rules. We did have a situation of a scheme, I think it was last year actually, where the scheme had no spousal benefits. So husband and wife situation, she had the pension. What would have happened in that situation was that the company would have paid out 5 years worth of pension. So assume the pension was 20,000 a year and she dies in year one, the husband would have received 5 years worth of payment. But it was 5 years worth from the date of the drawdown of the scheme. So if she dies at 4 years, 11 months, then there's only an additional 1 month payment. So that's why it's hugely important on the DB schemes for people to actually be aware of the different options or the different clauses within their DB scheme. This one was quite well hidden. It was actually, you know, the husband and the wife were actually totally unaware of what would have happened in that situation. If it's a defined contribution scheme and the husband or the wife dies, it does automatically pass to the spouse.
Yeah, typically for most schemes, the death benefit or the spousal benefit in the event of a death would be 50%. That would be the
Yeah,
typical
that would be the
route.
typical, yeah.
Yeah, yeah. Okay, and why don't we take one more? Okay, this one is a little bit complicated. My employer has both a DC and a DB scheme, so how do I calculate the tax-free lump sum? I'll let you take that one.
You don't, you get someone to do it. So what happens in that situation is where you see a lot of these is where the DB scheme has been up and running for a number of years, and the DC scheme is also their AVC scheme. So they've tied it in together. Or you could have a situation where the DB scheme has been all but closed down, and employees have now started contributing to a DC scheme. In either situation, the DC element is quite easy to calculate. It's you know, it's the value now, whereas the DB element will have to be calculated by the provider of the scheme. I would give a bit of advice to people in relation to that. The DB calculation, it's an actuarial calculation that's required for that net present value of the future tax-free lump sum. So it's very important for people to make sure that they actually ask for that figure in time. So if you're being made redundant tomorrow, don't go asking for it today, because they just won't be able to get it back to you. It's typically taking, I suppose we've seen it, Tracy, it's typically taking about 7 weeks at a minimum, almost for
And then
them to
some,
come back with those
yeah,
kind of figures.
yeah. Um, One last question then. So one individual was asked, if I was employed seasonally for 2 years before being employed full-time for 6 years, am I entitled to the redundancy for the seasonal year's service? So somebody who has worked seasonally for 2 years before being employed full-time for a following 6 years.
I don't think so, because I don't think they would
Different
qualify. I'd have to double check that, but I don't think they do. It depends on how long they were actually working, for in each of those seasons. Was it a couple of weeks? Was it a couple of months? You know, it does
I would imagine it depends a lot on the contract, the type of
it will
contract that.
depend. Yeah, it will depend on the contract. Was it for a specific period? If they want to send that one in directly to us, I can look at that for them. Whoever was the one that
Yeah,
asked.
that was a lady called Nuala. So Nuala, if you care to just maybe write us an email either to myself or Adrian, and we will clarify that detail for you and get back to you. Do
Yeah.
provide us a telephone number as well, and we can reach out to you that way too. So guys, I'm sorry we have run over time. Really hope this has been beneficial for you. And if you have any comments or observations, or yeah, please give us as much feedback. We'd be very grateful for that. So thank you very much.
Thanks, everyone.